Okay, so for these, we know that the business, big or small, usually needs some source of. No one will enter into business, purely speaking from the business point of view. Even if you have a whole full amount, you will not invest everything of your property or what you have into capital of that company, because when it's done, you left with nothing, right? You are often invites to look for raising more capital, right? Looking for your finance. It may be short-term financial aid, or it may be a long-term financial aid, but a company tend to look, especially when you begin to grow, when you want to flourish, though you don't have, you see the opportunity of growing, but you may not have your own hand on your own capital, but you have a ways to find it, right? Find it. So in this, I already share with you the syllabus, and we will try to cover all of them or as much as possible, okay, according to the speed we could go. And I will be share with you. The first one is an overview of finance, okay, long-term and short-term. And before we could know about long-term and short-term, we were looking at the type or different business you are in. It's depending on the type of business, what type is that you required, what type of finance, right? So I will share with you the okay. Are you able to see my screen?
Yes, ma'am.
Okay, so we were looking at the we are looking at the seven most popular type of businesses nowadays, because the advancements of business, and it's have been more types that coming into a position, right? But we were looking at these 7 popular traditional types of businesses that usually happen, right? Usually take place in the society around the world. And the first and foremost one, and in this chart, it help you, it's just a brief, right? It's just an introduction overview, just want you to introduce to you the types of the business, right? If you want to know more, interest more, you can read up about it. So with this chart, I saw that it's very nice overview for you to see. Immediately you know that by looking at the icon, you can know what it is, right? It's kind of self-explanation itself. So the first one is sole proprietorship, right? Sole proprietorship. So when you heard about this, you know that you see the picture, right? It's only one man standing. So it usually owned by one person. The person is the one who put in the capital. He or her by himself or herself. And there are no legal or financial distinction between business or business owner. Usually they are involved, because that is what he putting in, and that's what he drawing out. There is no much separation or distinction, although we know that for accounting you keep a very distinct record of the finance. But what it's trying to say here is that you are the owner, and it's basically owned by you, right? And partnership, right? The second one, partnership, you can see here they put only 2 pictures, right? Partnership here, which business and financial legal responsibility have to be equally divided, okay? Equally divided, because it's not just you alone anymore. There are somebody else money put into, and it have to your liability, your responsibility, and your benefit have to be equally divided. Hence, there's many legal responsibility that come along with it, and it must be registered for the IRS purpose. right? You have to register your company as partnership, right? As partnership. I think I have not taught your class, but I think last semester when we are learning about the, I think corporate accounting as well, we were talking briefly about a partnership, right? Partnership and the rule and regulation that involve in it and require for you to register your company under that in order to operate as partnership, okay? And when it move on to another one is a limited partnership. Okay, so let you see clearer. So limited partnership is it's ideal for those who are interested in raising capital from investor who aren't active in a day-to-day duty, right? So for example, you still need more capital to put into your company, but you need to raise money through some other investor. It means they will be co-owner to a certain percent, but they are not necessarily, all investors not necessarily be active involved in the welfare and day-to-day activity of the company. They could be just the silent investor who just only put in money and reap the profit if there is, or bear the liability or the losses if there is. Okay, so and this limited partnership, it's I think it's minimum 10 and up to minimum 3 up to 10 or up to 15, I think so, that the limited partnership is allowed, right? And cooperation, the next one is cooperation. Cooperation is another type of business where it's independence and it have a multiple shareholders, right? Multiple shareholders, and it's appropriate for established business with employee when you let your employee be part of your shareholders. Okay, then okay, LLC. Okay, this is a limited liability corporation. It's blended of partnership and cooperation, and there is no personal property at risk usually, and there is less regulation as well. Then you have the non-profit type of business. The earning pay expenses of the company. Usually they do not take out anything extra. For example, what they are earning, it will be neutralizing for the further well-being of the company. There's no drawing out of the profit, right? There's no drawing out of the profit. You may be, it doesn't mean that the non-profit business does not pay their worker. No, they paid, but it's out of those earning they paid out. They do not draw out as the percentage of profit and share for the owners, right? So they are the earning just to pay expenses of the company and the well-being, and they can apply for tax exempt status. Because you do not take out profit for yourself, hence you can exempt from tax if you are registered as the non-profit business. And then the cooperation. Cooperation, they are earnings divided among the members, and there is no external stakeholders, and the member use its services, right? The member can use its services of the company. So this is just the briefly 8 types of popular business structure. Now there are more, there may be more, but this is the traditional popular types of business. Okay, and in all these businesses, we know that there are 3 broad areas of financial management, right? There are 3 broad areas in the financial management. One is the capital budgeting, you will hear this term, and the capital structure of the business, and working capital management. Right? So now let's look at it individually briefly. Okay, so keep in mind this is the overview. Okay, the overview of financial situation, right? Financial information here. So it's just an overview briefly. When we move further along in the chapter, we will learn each of them separately. Okay, separately. So what is capital budgeting? So in a simple nutshell explanation, capital budgeting means that allocation of funds to different long-term assets. And what are those long-term assets? Long-term, I don't need to explain the what is asset, what is liability, right? At this toward this last semester of um, your study, your third year, you have to know what is asset and liability. If at this point of time you still doubting yourself, you don't understand what is asset, what is liability, I urge you that you have to go to the internet or go to your simple book, 12 standard commerce book or something, and try to understand a clear understanding of asset and liability. Because once you're not clear on that too, I don't think you are clear on the rest of them, because it's based on that. Financial and accounting, it's based on that two terms, right? And capital budgeting, come back to a capital budgeting, it's mean allocation of funds. So when we say allocation of fund, it's mean how to get the funds, right? How to we can say locate it, how to put the fund in different places, right? To a different long-term assets. So long-term assets, it means like investment in lands or machineries or infrastructure. When we say infrastructure, we are talking about the building, right? The building fixture of the company and distribution networks, etc. So these are all the long-term assets that usually owned by the company. So capital budgeting, it's mean you are thinking how you can put this money, right? When we say about capital, right, you hear the word asset, capital, and liability. So capital is capital plus asset equal to liability. That is the accounting equation, right? It's not a new thing. So this capital is means something that usually people look at your company, right? That you are able to handle, right? Your liability is mean those payment you have to pay it out. And capital usually it show your backbone of the company. Okay, so capital budgeting is how you can divide those money, putting in a long-term asset places that will benefit you the best. So there are way and techniques of helping you where you can budget it that give you the most benefit out of your capital. Okay, and it may be involved even in investment in many projects. So that is basically capital budgeting mean, is the allocation of funds to a different long-term assets. Okay, so that is the one sentences that when it comes to capital budgeting you can understand, is allocation of funds to different long-term assets. And what is capital structure of a company then? So capital structure is involved that determining the best mix of debt and equity or hybrid security to employ. You feel like, okay, these sentences, the word is so fancy, right? But there is no other technical term where you can simplify it when it comes to finance and accounting, right? You cannot use other word than equity or debts or these security, bond or share. You have to well versed with these terms, right? With these terms. If you are not sure, you can look up, right? Look up. Don't keep unclear concept in your mind. And so this is where the company thinking, okay, what should I when we're talking about clothing, many of you are you're here, you know of mix and match, right? You wear this color with that color, you wear that top set with that skirt. So you mix and match so that you want to look best. So the same way in a company, for the capital, the fund of the company, you want to mix and match your strategy. And what are these strategy? It's the debts. When we're talking about debts, it's mean we are taking someone's money, right? We are owing to them. So how much percentage we should owe, and what is the a time period, a short term or a long term, and how much is we are taking these fund, so that you will put together some short term, some long term in period of time where it could benefit you, right? You are taking someone else's money not to just spend. For a business, any rupees, it counts in multiplying and earning. So you have, before you're taking a loan from any financial institution, you have to have that capital structure strategy where you know where to invest, how to use this, utilize this money that give you the best benefit back. So when a firm have decided their investment project, what they want to undertake, what they have to, so now they will try to figure out the way to finance them, right? So the capital structure to finance them. So the key issue of capital structure decision, usually the question that arise when they are making a capital structure decision, is that what should be the optimal debt equity ratio. So when you study in financial, I think there is another course that you're studying the financial statement, not the analysis, just financial statement, right? You will study about these ratio. So these ratio we may be touching as well. It called as the debt equity ratio, where you calculating of your debt over your turnover of paying back. So what are the ratio, right? What are most likely you take the loan and can return back, or how much you are put in and you're getting back, right? So usually when it comes to capital structure is that question of what should be the optimal debt equity ratio, up to how long you can take this money and return back. And so according to that, it's determining the long and short term finance that you can raise, and which specific instrument should be employed, and which capital market should the firm access. It means from which a financial market, like financial firm where you are taking this loan from, or when should the firm raise the finances, and or what price the firm should offer its security. It means you put out your like when you go to borrow someone, you have to give them that security, right? Like for example, if we're saying a simple term, like you put in your house to take more mortgage from it, or money or loan from it, so you have to have a security, right? Security to give in order to take back. So now you have to make sure that you're able to return back that money in order to get back what belongs to you as well. So at what price? It means if I put this infrastructure as a security, in what price should I be getting offer for that security? And beside all these questions, is what should be the optimal dividend payout ratio. So these are all the ratio that you will be studying in this subject, as well as maybe financial statement. There you will hear some of these terms. It's mean dividend payout ratio is how much dividend is the interest you paid to your shareholder. Okay, so dividend is the interest, the money you give to the shareholder. Shareholder bought your share, you have a percentage to give them back. So those money that you give them back, it's called as dividend. Pay out dividend mean to pay this money back to the shareholder. Okay, so the question of capital structure here is what should be optimal. Optimal is mean the maximum give out a dividend to your shareholder. And in this case of objective is to minimize the cost of financing without impairing the ability of the firm to raise finance. When we raise these finances, it doesn't mean you just without any expenses incur. You have to spend some money to able to, like, with some legal requirements and many other things, that in order for you to acquire, it means to get some of these finances. So those expenses that involve in raising those funds is called as the cost of financing, right? Cost of financing. So you have to able to figure out how to minimize. When it comes to cost, it's in a business is always minimize the cost, maximize the profit. Okay, minimize the cost, maximize the profit. Then the last one is working capital management. Okay, so these are the 3 criteria in the financial management that all these type of business that we just seen that they need to look at, right? The first one is capital budgeting, and the second one is the capital structure, and then the working capital management. So working capital management is also referred as the short-term financing decision. So this capital budgeting usually involve long-term, right? You know, a long-term or maybe short-term. But when we talk about working capital management, these are the short-term things. You are taking capital in order to manage what in front of you right now, the work that in progress right now. You need the circulation of the money. So working capital is referred to the short-term financing decision. And it's related to day-to-day financing activity that we are dealing with. It's dealing with, when we talk about working capital, you will hear the term that involve a lot. It deals with current asset, right? Current asset. So what is current asset? Current assets, they are like your inventories. If you are in the manufacturing company, how many units that you already have produced in your that you are having your raw material in hands, right? And they are part of your inventory, current asset. And debtor, it's mean those who are owe money to you. They are that you are yet to receive money from them, right? And trade creditor is we owing money to them, and we are all usually it's short term, right? We identify all of this if you think of balance sheet, right? You will list down in the balance sheet in asset and liability side, right? So both asset, how do you list down your asset? It's starting with the current asset. When we say the word current asset, it's mean they have the ability to convert them into money fast, right? We're able to convert them into money fast, because such asset like capital and all, it's a big fixture. You cannot in 2 days or 5 days to sell that building and collect money. No. And what able to use in our day-to-day work is involved in the current asset, where, for example, debtor, it means someone is owing you money. Immediately you can collect money from that person. And your trade creditor, that you have give them the able to take credit from you, so you able to collect them back. Okay, we need back the money now, within the week you have to pay. So these are all the current asset where you can convert those into cash quickly, right? So they are the current asset. And sorry, and short-term holdings, marketable security, and cash. So they are your current asset, and cash is the most liquidity one. It's always right at the top in the balance sheet side, right? Because it's the most money, because ultimately the other thing, debtor, short-term holding, market security, and bonds and everything you bought, will convert it later into cash, that we call as liquidity of the company, the ability to convert this current asset into cash, right? And then it's dealing with current liability. So in the working capital, there is also the formula of working capital, right? So which we will look at later in the chapters to see how to calculate all these working capital and such. So current liability is the short-term debt, trade creditor, accrual, and provision. So the key issue in this case, the question working capital is that what should be the optimum level of inventory? And what are the credit policy of the firm? It means what are the rule or policy that you allowed other to pay you back, right? To pay you back. For example, if they take supply from you 15 days, they should return back. 30 days, they should return back with a certain interest or so. So working capital management, you have to have this inventory level, this credit policy, and it will be dealing with the issue of where should the firm invest in short-term cash surpluses. For example, in business, when you have money, you cannot just hold money in hand. If you hold money in hand, your money do not grow. We hear the term growing money, right? Business, they grow money. So when they have a surplus, which means it's a cash in hand, they don't just keep idle like that. They will give it out if they don't need it. They invest in certain places so that they can grow money. Each day pass by with their money idle, it does not grow. Business always looking to grow their money. So they have to have a short-term cash supply. And what are the sources of short-term finance that are appropriate for the firm to use, right? If they immediately need some money to run their weekly money payout, where they have to identify which source of that finance that they can quickly go and get in a short term, right? So these are all when we're dealing with capital management. So now let's capture back what we have just learned today. Okay, so we have learned the 8 different types of businesses. Sole proprietor, partnership, limited partnership, corporation, non-profit, and LLC, limited liability company, then cooperation, right? Cooperation. And then we are learning the 3 broad areas in the financial management of these businesses that all businesses need is 1, the capital budgeting, 2, the capital structure, and then working capital management. When we talk about capital budgeting, it's talking about how do you invest allocated these funds, invest in a long-term things in order to get the benefit out of it. Then the capital structure, how to mix and match, how much debt you should have, how much money you should lend out that will come into your optimal, basically a long-term optimal investment that you're reaping at. When we're talking about working capital management, we're talking about how you can dealing with a short-term finance, right? To solve the day-to-day activity, it's dealing with current asset and it's dealing with the current liability. So that's it for today, and we will